we'll talk a little bit about amortization and intangible assets. And amortization gets reported in Part 6 of the 4562. It's the very last section on the form. And when you have an intangible asset that you're taking amortization on, in that first year, there is, like the listed property, there's much more information that's required or requested about it. So not only am I showing the amount of the property, but also what is the recovery period I'm taking it over, and then also what is the code section I'm taking that over. A lot of times you see this actually gets misreported more often than not. Most of the time you see where somebody will report it and they'll say it's a Section 197 asset, which we're going to go through that in a second, but that's just something that's very specific and only applies in certain circumstances. A lot of times you'll just see that section left off and be blank. Again, it is required information, and the IRS is really using this because they want to see, are you actually taking it over the appropriate life? So Section 197 intangibles. Section 197 intangibles, these are purchased assets. So if I buy a business and I acquire a company, these are going to be the things like Goodwill, going concern value, the workforce in place I'm buying. It's all of those things that the seller wants you to call capital gain property, so they get a more beneficial tax treatment of it. Well, as a purchaser, you're going to take this over a much longer period of time. So with a purchased intangible, you're going to take this over 15 years, regardless of how long it may actually last. So, for example, you may look at something and say, well, I'm buying a franchise fee or a trademark, and maybe there's only 5 years left in that franchise. However, because that's considered a Section 197 asset, I have to take that over 15 years regardless. Goodwill is another one that's very common that you'd see that you're required to take over 15 years. Any kind of customer-based intangibles or covenants not to compete. Again, this is one of those areas that a lot of times people look at and say, well, I only have a 3-year covenant not to compete. However, for tax purposes, you are stuck amortizing that over a 15-year period. Now, I'm not an auditor, but my understanding is on some of these things that, when you look at this and say, why do I have to take it over 15 years, that from the tax standpoint, you would have you're actually able to deduct it, whereas, Goodwill for financial accounting purposes, you pretty much have to stick it on your balance sheet and then just look at it each year and determine if it's still relevant or not. And to the extent that it is, you have to carry that for basically, as long as the company stays in business. Question came in about whether or not buying out a lease would be a Section 197 asset. And unless that lease was acquired as part of a business, the answer would be no, and you would typically, we'll go over that in a second, but it would be subject to the normal amortization period of the lease. However, if it's a lease that's acquired as part of the purchase, so I came in, I bought a business, and I'm paying something for that lease in place, I would actually have to take that over 15 years. Okay, so we kind of talked about, what Section 197 assets are. So what are they not? And that's going to be a financial interest in a company. So that's going to be, by definition, if I'm buying a company, it's an investment that I'm going to record, and I'm not able to amortize that over the life of over the 15-year period. Certain contracts would also not be a Section 197 asset. Any interest in the land, or really any hard asset, when you look at this, clearly a tangible asset is not, but even though land is not considered a tangible asset, it is in as much as it's something you can touch, and it does have, it is a physical asset, so you would not be able to take amortization expense on land. You just have to capitalize that. And again, you capitalize it and carry it for as long as you own that property. And then off-the-shelf computer software would not be a Section 197 intangible. Even in the situation where I purchased this as part of a business, to the extent that I'm going to allocate some of my purchase price, I would go ahead and take this over the 3-year straight-line depreciation purposes. Okay, somebody talked about, the question comes up oftentimes is, you said, okay, I got to carry this asset for 15 years, but what if I don't keep it for that whole period of time? To the extent that if you have a Section 197 asset, okay, if you have a Section 197 intangible and it's disposed of, and there are other Section 197 intangibles that were acquired in that same transaction, you don't get to take a loss on that specific one that was disposed of. So this is an example of you acquire a business, and part of that business has a non-compete agreement, which is invalid after 3 years. You can't go ahead and say, well, I'm going to write this off now, because to the extent that you do it, you would adjust the basis and the remaining assets that you still have by the amount of that unamortized balance. So in the end, if you have one Section 197 asset that was acquired as part of that purchase, you will end up taking that full amount over the 15-year period. Now, a couple of other provisions a couple of other common intangible asset amortization provisions I just want to hit on is business startup costs. Not as common as you used to be, because you are now allowed to take a certain amount up front. Used to be that if there were any costs incurred prior to opening your doors, you were required to amortize those under Section 195. That's still the case. However, again, there is a fairly generous expensing threshold of that. Now, your business startup costs are going to be, by definition, these are those costs that you incur before you actually open your doors for business. So if you're forming a new venture and you're incurring salaries and things like that, but you actually haven't opened your door and your product is not available for sale to the consumers yet, those are going to be startup costs that you're going to be required to capitalize those and amortize those. And then a couple of other ones, and this goes back to the question earlier about the loans commissions, leasing commissions, loan commissions, is that unlike the Section 195 assets and the 197 assets, loan commissions and expenses as well as leasing commissions are actually amortizable over the term of the contract. So if I have a loan and it's a 7-year loan, then I'm going to amortize those costs over that full 7-year loan. Leasing commissions are going to be the same thing. Now, with leasing commissions, it's a little bit different because you do have to look at optional renewals and the likelihood of renewing a lease. So if I have a lease that may be a 5-year lease, but it's very unlikely that I'm going to vacate that property over 5 years because there's an option on it and it's just going to be cost prohibitive to do so, I may be stuck, amortizing those over a 10-year period or 15-year period, whatever those renewal options are that are added to the original contract. Same would apply for loan commissions, although I can't really think of a situation where a loan would be extended, because normally if you're going to pay an extension fee, you would pay a separate fee at the time the loan becomes due. This would also go not just with the commissions, but any other costs that are incurred as part of that fee. So if you're paying points or you're having to buy down interest or anything like that on the front end, that would also be amortized over the life of the loan. And then finally, I'm going to just briefly mention when you purchase intangibles, there are some rules that would apply in a transaction. If you purchase the intangibles and you're amortizing them, but you really don't have a significant change in the use of the business, there are something that's called the anti-churning rules, which would say that you can't actually amortize those costs over the 15-year period if any of the following apply. If you or someone related to you, and this you'd have to look at the related party rules under Section 267 to determine what's actually considered a related party. But if you held that property and used it at any time between 91 to 93, it's going to apply. Or you acquired the intangible property from a person who held it at any time during that period and the use did not change. Or you granted the right of the use of the intangible to a person who held it and used it at any time during that period. Again, you can kind of see from the date range, I sort of blew through that quick because you kind of look at the date range and see that you're really very highly unlikely that that is going to apply. However, if you do have a situation where you have related party transactions, then you want to make sure, and you have intangibles involved, you want to make sure that you look closely at that and make sure that you actually can continue to amortize those over that 15-year period.